Hey friend, Steve here with IBC Global. Today, I'm going to go over a retirement strategy that I recently put together for a couple who are in their mid-50s. They're interested in retiring within the next 2 to 5 years, and they'd like to have income of at least $100,000 per year. Let's get on into it. So what we're going to cover are a number of things, but we'll start with why they initially reached out. So the wife initially reached out with an interest in a whole life insurance policy specifically for high cash value. And the main reason why is because many years ago, they were each sold indexed universal life insurance policies, also known as IULs, and those policies have not performed very well. They have had them for a long time. The husband has had his close to 20 years and still has a negative return on cash value. We'll also talk about annuities. We'll go over how they work and how in their particular situation, they can provide a guaranteed income stream. And then we'll see how we can use all of this to retire within the next 2 to 5 years, all while meeting their goal of having at least $100,000 per year in annual income. So what we'll look at first are the different life insurance options. For the wife, we looked at several different companies, but she selected MassMutual, and we have a policy that has a minimum premium of about $5,000 per year, but the maximum funding and what she plans on adding every year is $20,000. She has approximately $80,000 in her current IUL policy, and she plans on transferring that over to the whole life insurance policy. We did a thorough analysis on that, and that IUL was not performing at all, so it made sense to move the funds over. So let's take a look at her policy first, shall we? I'm just going to pull the numbers up on Excel, and here's what we've got. So initially, we've got a 1035 exchange of $80,000 coming over. In addition to that, she's funding $20,000 per year. So the total policy input is $100,000 in year one, because she paid $20,000 and she also has an $80,000 transfer. Anyway, cash value looks fantastic right out of the gates, $94,000. And by year 3, she's cash positive. You typically only see that with MassMutual policies if we have a 1035 exchange going on. So her policy looks quite attractive. Let's take a look at her husband's. So for the husband, he's looking at $20,000 per year going in, similar to his wife. With the minimum premium, he's looking at about $2,000. Now, that's the base premium. With the term insurance rider, you'll find that the true minimum comes out closer to $2,700 per year. For the 1035 exchange, he has $32,000 being rolled over. So let's take a look at this, shall we? Here's what we've got. 1035 exchange. We mentioned 32. For the illustration, we rounded down to 30K. The minimum premium, $2,700. PUAs, $17,300. Remember that minimum premium includes the base premium plus the cost of term. But to simplify, he plans on paying $20,000 plus the 1035 exchange of $30,000 right out of the gates. Kicks things off with a total input of $50,000 in the first year. And the break-even point is just about year 3. Side note for him, we actually explored a policy half this size as well, with closer to a $1,000 minimum premium and a maximum of $10K per year. And he liked that option a lot. But for the sake of this original plan, we're looking at the 20K model. All right, so let's go back to our outline. The 1035 exchange of about $32K came from products with Nationwide and Transamerica. But again, when we analyzed the returns, they were just performing horribly. He had them for a long time. We did look to try to improve the IUL products he had, meaning if he pays in more, that can sometimes improve the cash value. It didn't, and he's just said this is not worth it, and I agreed. And typically I prefer keeping an existing policy and trying to improve it or enhance the overall cash value growth before 1035 exchanging. Next, Annuity Education and products. So they're interested in annuities primarily for the income guarantees. So there are three types of fixed annuities that we looked at. The first is very, very simple. A fixed rate annuity, also referred to as a MYGA, which stands for multi-year guaranteed annuity. This is a lot like a CD at a bank where whatever the interest rate is, that's a lock. So for example, I could purchase a 7-year fixed annuity with a 5% interest rate, if that's where rates are when I buy it, and it's guaranteed to be locked in for that 7-year term. So folks who are very, very conservative, a lot of times like that type of annuity. Then we've got an indexed annuity, which does offer some greater upside on the growth, especially when compared to a fixed rate annuity. How it typically works is that my money is tied to the S&P 500 index, and if the market goes up, my money goes up with it. If the market goes down, my principal is protected. Now there are caps that limit the earnings on my annuity. Those cap rates can be adjusted. There's things I do want to be aware of. A lot of times when we look at indexed annuities, I like to look at a company that either A, has a guaranteed cap rate, or it's a cap rate lock where I know it's guaranteed for a certain term, like a 7-year period or something like that. Or we're looking at an insurance carrier that has a strong renewal rate history, meaning they have a history of not slashing the cap rate once I'm in the product for a couple of years. But if I'm interested in accumulation, that can be a nice product to consider, although there's definitely some things we want to look out for there. And then we've got guaranteed income annuities. This is what they were interested in. So how it works is you give the insurance company a big pile of money. The insurance company says, thank you for your money. But then they turn around and say, in exchange for this pile of cash that you gave us, we will guarantee you income for the rest of your life. It's similar to a pension. That's not compliant, they're different, but it is similar to a pension where I will have an income stream that's paid to me. And you can set it up where it's also lifetime income. Now there are some drawbacks. Let's hit on those first. These annuities, in my opinion, are not ideal for growing your account balance. If I'm looking at the account balance, meaning I give an insurance company $100,000, I would set expectations to expect a very low return on the principal balance, and I would also have very limited access to my principal during the first 10 years, or whatever the surrender period is. Typically, income annuities, if I'm going with an annuity with an income rider, for example, have a fee attached, which is going to drag on the account value balance, meaning it's not going to grow that much. But with that said, most people who are interested in these types of annuities are not looking to grow the account balance. They would look at something different for that, which leads me into the advantages. The advantages is that you can set it up where it's guaranteed income forever, and even after you deplete your balance, you'll continue to receive that income stream, which is why people like this a lot. Now there's multiple ways you can fund these annuities. It can be with cash, it can be transferring money from another annuity, 401k, IRA, Roth accounts. You could even transfer money from a life insurance policy, although I don't really recommend that based on the tax treatment and such. When we eventually take income from the annuity, the income we receive is going to be subject to the same tax treatment as the original account. Meaning if I fund an annuity with a 401k, if I transfer the money, if I would have taken money from that 401k, I have to pay income tax when I take it. If I take it before 59.5, I have that 10% penalty tax with the IRS. If I transfer money from a 401 to an annuity, and then I take income from that annuity, I have to pay income tax on everything. If I take income prior to age 59.5, I have to pay that 10% penalty tax. So that's one example, being a 401k. There's more to it when I look at annuities and such, but generally speaking, the tax treatment will be the same. Moving it into an annuity doesn't really change the tax treatment with most accounts. Again, there's more to it, so don't quote me on exactly what I just said there and take it as fact for all annuities across the board. Retirement options. We're just going to look at version 1 here. I put together more than one for them when I put all of this together, but it involves the wife retiring in 2 years, which is what she wants to do, and the husband retiring in 4 years. If possible, the husband would also like to retire in 2 years, but I don't know if he really wants to. He wants to retire soon, but just looking at everything, he's conservative and he might enjoy working. Couldn't quite tell from our conversations. I do, which is probably why I assume that. I enjoy working, that is. So let's take a look here. Plan 1, the existing retirement accounts that they have. The husband is looking to transfer $220,000 that he has in an old variable annuity with an income guarantee to a new annuity with a new guaranteed income rider. The reason why is because the guaranteed income is a lot higher than the old one. When that policy was issued, the income guarantees were not that strong, so he's like, why would I do this? It was kind of a no-brainer, which was nice. For the wife, we're looking at a $270,000 IRA transfer, and then also for the husband, we're looking at his $100,000 IRA to move to an income annuity. And to be clear, we don't have to do all of this. We actually didn't do all of this. This was just the original Plan 1 proposal. They also have 401k accounts. So with the 401s, can't do anything with them right now, but because they're primarily interested in income, we're looking to move those potentially into a guaranteed income annuity when they eventually retire. They also have a lot of other assets, which I'll show you in a little bit. So we're not taking all of their money and moving it into annuities. They've got stocks, bonds, mutual funds, Roth accounts. They've got a lot going on. They're looking to downsize, specifically sell their current home that's valued at about $850,000, the low mortgage balance, and then move into a new home that'll cost about $500,000, and they'll net about $100,000 when it's all said and done, very conservatively. We looked at conservative numbers here. And that 100K is actually going to be important in looking at the income model we put together. And then we've also got some additional information in terms of their income streams and their different accounts with their Roth, stocks and mutual funds, and rental properties that they own. So what I like to do, kind of as step 1 for someone in a situation like this, is see what things look like. So step 1 that I want to look at here is the annuities. So whenever we're looking at an annuity, we like to look at the income payments. So for example, here's an annuity for the husband. He's looking to transfer $220,000. And what's highlighted in yellow is if he waits until he's 60 to start taking income, it'll pay him about $21,500 per year. And that's the guaranteed income he'll receive. If he waits until he's 65, it'll be closer to $31,000. The longer I wait, the greater the income is. Look at the wife's annuity of $270,000. What's highlighted in yellow is when they plan to start taking income, as this will all line up with the model. So what we're doing here is strategically using annuities to ensure they can hit that income of at least $100,000, which I actually talked to them and recommended it should be higher, just with the cost of living and everything else going up, 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 up. So here's what we've got going on. Right now, they're working. Husband makes about $180 per year. This year, closer to $170. The following 3 years will be about $180. Whereas the wife makes $170. Household income is healthy. They earn income well beyond what they need to live on. So they've been able to save a lot, which is nice. Social Security, they're looking to take that early, both at 62 years old. So we see exactly what that will be. Rental income. So their rental income is a gross figure of $20,000 per property. The wife said, you know what? Cut it in half, shoot it super conservative. It's probably going to be more than this, but if this model works with the income projection at $10K per property, we're golden. So we ran it super conservative, just like the annuities being very conservative. We've got their home sale. This is the current home that they're in. When they sell this in 2029, they'll end up with about $100,000 net. And then we've got the annuities over here. So these are the same income figures we just looked at. This is when they plan on starting to take the income. A lot going on. Here's how we simplify it. Total income. So while they are working, what do we see? Well above $100,000 per year, which satisfies all of their costs. Their costs will go down a little bit when they sell their primary home and downsize. When they sell their home, they've got that 100 there, which bumps their income that year to about 170. After that, check this out. They're above 150 indefinitely. And this is with very reliable sources of income. You've got Social Security, depending on your opinion, that may or may not be reliable, but you know what I mean, has been here forever. We've got the rental income, which is very conservative here. It's most likely going to be higher. And then the annuities, which are all with A-rated companies and all have contractual guarantees here. So they liked that word guarantee or guaranteed income. That's what attracted them to this. So those annuities will continue to pay literally until they die. So they've got that coming to them indefinitely. So what we like to look at as kind of a final piece to models like this are your assets. What does your net worth look like while you are also receiving income? Specifically, is it going down? So here we go. Here's phase 2, our assets. So cash, they've got a lot of money in cash. They should probably put that in some other areas, which they're kind of doing with their whole life insurance policies. But if we go back to the policies, you know that they are small relative to what they have in cash. They probably will do some other things with their cash, but we ran a conservative growth rate here of 2%. They're probably going to put it somewhere else. They've got money in stocks, Roth accounts as well. The growth rate will probably do better than 5%, and we can adjust that. We set these models up so they're easily adjustable, but at the same time, we ran it at 5% just to keep it conservative. Then we've got the whole life insurance policies. The cash value is theirs, easy to access, can do that through loans or withdrawals after year 7. If they're taking loans, they're not required to pay them back or the loan interest. We just show them how much they can loan without the need to pay anything back and prevent the policy from lapsing. And then we've got the totals. So while alive, this shows the liquidity that they have. A lot of this being in cash. But this is money they can access in addition to that income of about $180,000 per year. Remember, their goal was $100,000 initially. Remember when the wife saw it, she was like, that gave me so much peace of mind because I didn't know if her assets were going to be able to produce the income I wanted to be able to have during retirement. Now she looks at this, has the income she wants, along with the appreciation here. Everything's conservative, especially the cash and the whole life insurance policies, and it continues to appreciate. So they'll have more than enough income. And then at death, when they eventually kick the bucket, what do we have here? Here's what goes to the kids, excluding the home. So we'd actually add the real estate value and the rental properties, but call this just liquidity, which is cash, stocks, and a Roth. Oh, and I forgot the most important piece. The death benefits that are paid income tax-free. So the kids are getting a lot of money that's going to have tax-favorable treatment. The life insurance is paid income tax-free. So overall, what we're able to do with this, when we look at the plan, is their income of $100K per year during retirement? Check. We're able to accomplish that, which is fantastic. Continue to grow their net worth? Check. In a very, very conservative manner. And then third, leave a tax-free legacy to their children, which they're very, very happy about. And that was all with life insurance and annuities and an extremely conservative approach, which we actually looked at some additional options and they're doing things a little bit differently, but they are in a fantastic position. I hope you enjoyed this video. If you did, I included a similar one you can check out here.